This podcast was inspired by an absolute disaster that Vic experienced a couple of years ago, which probably up until this point, you haven't felt comfortable talking about.
No, I haven't. But you know what? We live and we learn, and I'm going to share my learnings with you of feeling very overwhelmed when mortgage rates went up.
Yes. Vic essentially had her interest rates, like a lot of other people, like triple, and an unbelievably stressful experience for people to all of a sudden have to genuinely wonder how they're going to get through a cycle of very high interest rates. So this whole episode is about how to navigate mortgage overwhelm. We speak about Vic's experience. We also did a history of mortgage rates and what we can learn from a long period of time. Because, one of the things that you spoke about in this episode, Vic, was you kind of don't know what you don't know. So your experience, if it's been 5 years of owning property or 10, there's a huge amount that you can learn from history.
Yeah.
In terms of when you should be locking in interest rates or staying floating.
And we also go through 5 steps to take if you are in a situation where you're feeling overwhelmed right now.
This is a really good conversation if you are feeling overwhelmed, if you own property and you want to make sure you know what to do if you are ever feeling overwhelmed, or if you're potentially about to buy your first property and you want to make sure that you are navigating this with eyes wide open. This is a really good episode for anyone that's interested in investing in property or already is. Welcome to another episode of the Property Podcast. I am loving this series. It's so fun to be able to talk about a different asset class. I mean, it's been years that we've spoken about the stock market, so to be able to really dive into property, I'm loving. We just wanted to share a message from our partners BNZ, who know that home ownership is not a straight line. Sometimes life just does throw you curveballs and there's actually nothing you can do about it. You just have to remember that they're all about supporting you through the hard stuff, not just the highlights. So if you are in a position where you're having a total meltdown or something's not gone to plan, just remember that the sooner that you talk to the bank, the more options that you will have. And it is never too late, no matter how dire things feel, to reach out. They are always there to help and not judge. So whether you're at the start of your journey or you're rebuilding, whatever has gone wrong, remember that BNZ has got the tools and the people, and they're ready to help you find a way. Thank you so much to BNZ for empowering this podcast, and let's get into it. So today we are talking about mortgage overwhelm and how you can, I guess, prevent it or think about it differently. Get through it. If you haven't bought a house, how you can think in advance, what would worst case scenario be, and how can I make sure that I'd be fine if that happened? You own a house. You know, it's a really positive start to the year. We don't know what's going to happen with interest rates.
No, we don't.
But it's important to not let stuff like this creep up on you and then be in a position like Vic was in 2023, which was pretty bloody stressful.
Yeah. But we survived. What doesn't
kill us
makes you stronger?
I mean, do you feel like that about that time when it comes to your house?
I feel like anything in life. I remember someone said to me, they're like, Vic, you've survived 100% of the bad days in your life. I was like, true.
I love that.
Yeah. It's like whenever you think that the world's ending or like you're in a ball crying on the ground, you know.
You've had worse and you've dealt with it. Someone said something similar to me the other day where they were sort of saying it's a future you problem and you just have to trust that future you is going to be able to figure out whatever the situation is. And I quite like that. Oh, what? Oh, God, we're going into quotes.
Yeah.
What is it?
There is no such thing as unspent money. You spend every single cent you've ever earned. You spend every dollar in your bank account, whether you know it or not. Money you haven't spent buys something intangible but valuable. It buys freedom, independence, and being able to spend time in your own way. Every dollar of savings buys a claim check on your future, and every dollar of debt you hold is a piece of future that someone else controls. So it's essentially saying, like, even though you're like, this is money I'm not spending, it's like, no, you're spending that on freedom, independence, because you're putting it away for the future.
Oh, I like that.
So when we say like leftover money, like there's no such thing.
Powerful.
Yeah.
Did you write that down? Did you read it in a book or did you find it online?
I read it in a book. I was going to lie and be like, made it up. Lol.
What book?
The Art of Spending Money.
Oh, I'm so excited for this book review. We have been talking about it for months, so sorry for everyone that keeps
really
hearing us talk about it.
It is a really great book.
Okay, so Vic.
Yes.
In 2023, you ended up in a situation where you were completely overwhelmed by your mortgage.
Yeah.
Lots of moving parts, lots of things were happening for you personally, for us business-wise.
Yep.
Can you maybe just set the scene for what was going on for your life, work, etc.?
Yep.
And just, the economic landscape that meant you landed in a position that was really stressful and not really what you had planned?
So I bought my house in Auckland in New Zealand in 2017. So 9 years ago.
Wow.
Yeah.
It's a long time. And also I think a really good example of how if you buy in the right area or an up and coming area, it can be so much more valuable in the future. Because when you bought where you did, it was kind of scary.
Yeah, and everyone's like, you're buying at the top of the market. But also, I think also the time thing, right? Like 10 years goes so quickly. It honestly feels like I bought it a few years ago. Do you know what I mean? Like when we always say like invest for 5 years minimum or 10 years minimum, like that goes so quickly. That's why it's always like get started ASAP, because you honestly, and I feel like so old saying this, but like you will honestly blink and it'll be 10 years. You know, I always feel like I'm like, oh gosh, time's flying by, but it actually is.
Oh, totally.
Yeah. But yes, bought my house for 1.5 million New Zealand dollars. So roughly like 700,000 pounds.
And it wasn't really a doer-upper, was it? Like you needed to do stuff to it, but you could totally live in it straight away if you wanted.
Yeah, I could. Like the kitchen was kind of falling apart and gross, but it was like livable. Yeah. And there was like obviously stuff that roughed me up. Like I think just having no carpet in bedrooms.
Yeah.
Do you have carpet in your bedroom? I feel like
I do actually.
It's so much more cozy. I don't know. Some people might not bother, but I just really found it quite like
hard.
Yeah.
It's funny because the houses that I've lived in where there hasn't been carpet in the bedroom, I think it looks way chicer.
Yeah.
It doesn't feel. I mean, if you looked at the carpet in my current bedroom, it's quite gross.
Yeah.
So it's not exactly nice. I probably would prefer there to be none. But there's something about stepping out of bed and being on carpet that's nice.
Yeah, especially in winter and stuff. Yeah. That was one of the first things I did was put carpet down. Yeah, my salary at the time was like 300,000 a year, which is about 120,000 pounds a year. So it was like decent.
You were in a position where you were.
Yeah.
Well, I mean, it's so funny because obviously we both earn the same amount now, which is, not even a quarter of that. So what you're trying to say here is like you bought a valuable house.
Yes.
But it wasn't as though things were like totally out of reach for you. No. You were able to service the mortgage really comfortably on the salary that you were on. So it's kind of a no-brainer in terms of the amount you were able to leverage from the bank.
I had a mortgage of about 900,000, so nearly $1 million mortgage, and interest rates were about 3.5% at that time. So
did you put a deposit down that was way more than what you needed, basically?
Yeah. Because I wanted to have as little mortgage as possible because it was just me as well. So if I did lose my job or couldn't pay that,
it just felt safer.
Yeah, it was just like
you've always been funny about debt.
And I think my mum was just like, make sure you put down as much as you can. Whereas like I would preface that with just being aware, and I think we kind of get to this, is like there's always things that you need to leave room for, like it might be new carpet, or it might need, you might need to pay insurance. You might need, there's like things you might actually want to buy furniture that fits the place. So like don't put down every single cent you have into a deposit, because there's always like, it's almost like an emergency fund if you're buying property. It's like just leave a little buffer.
I think that's a really common mistake that a lot of first home buyers do because you're trying so hard to scrounge around and find all the things that you need and to have enough to be able to actually get there.
Yeah.
A lot of the time you maybe purchase slightly early and you don't have as much buffer as you probably need.
Or you're like, let's put in this extra 5,000 into the deposit so then we can borrow more. But it's like, but you actually, you don't want to be moving in and not being able to afford cups and saucers.
And also so much can like come out of the woodwork, literally there might be something that's rotting. There's so many things that you just don't know. A house, you can do as much DD as you want, but the reality is there's always going to be things that pop up.
I remember when I first got given the keys and like took over the house, when I walked in and the house had been staged for the open home. So it looked beautiful. And then obviously all that, you don't buy all the beds and the, the tables and the couches, and that all got taken away. And I walked in and I was like, this is what I've spent all my money on. Like it is just wood at the end of the day. It's like wooden foundations. It's like, cool.
I also feel like when you don't have stuff in a place, it makes it look so much smaller.
Yeah.
So you would have walked in and been like, oh, my value for money is not as high as I thought. But so at the time in the world, what was going on?
Trump had actually just got into power.
What?
I know.
His first round?
His first round.
That's so funny.
And I remember everyone being like, Well, like you just didn't really
Shit,
know
was it
what.
that long ago?
Yeah.
He's been at this for a decent amount of time,
Yeah.
hasn't he?
We had Trump, then we had Biden, then we had Trump.
Yeah, right.
Yeah.
Wow.
I'm
flies.
So
I'm having fun.
Yeah. I bought this and then the world kind of went a bit crazy.
So how long after you bought it? So in 2017, is that when Trump was in? And at the time, your mortgage rates were about 3.5% in terms of interest.
Then
what is that as an annual amount?
So
around?
Interest, it's about 30,000 in interest per year.
Okay.
$30,000 in interest. And then you have to pay some principal on top of that. So let's say like 40,000 a year.
Mm-hmm.
Yeah.
And so at this point in time,
I was paying interest and I was paying principal. And then 2 years later, I was like, I'm going to renovate. So I borrowed $100K from the bank. So I've effectively been paying off for the last 2 years.
And then you went back and debt again.
I was like, paying it off and then like, can I have that money back actually? So yeah.
Is that quite common? Lots of people do that, don't they? Where it's almost like because you're borrowing money from the bank to add value to your shared asset that you own with the bank.
Yeah.
They're happy to give you that money because it increases the value of what.
Yeah.
Which is really interesting because they don't take a profit from the increase in the value. They just take back what you've borrowed.
They're just worried about can they sell the house and still get their money back. So if you're borrowing money to add value, then you're going to sell the house for more, hopefully, and you're still going to get the money back.
But do you know what I mean in terms of because when you leverage from a bank, they're not trying to make money out of you in terms of the compounding returns on your asset.
But you pay interest on the amount they borrow.
Of course. So
So they're like,
that's
of
so
course,
stupid.
borrow more, but to an extent.
Yeah, and then they're also giving you interest on it. So you borrow that $100,000 again, and you have to pay interest on that amount. So that's where they're making money.
You wouldn't be able to borrow that money if you were already at such a high percentage in terms of the equity and the debt. But because I'd put down more, I was able to, like, it was an easier conversation. But I remember going to the bank and I was like, hey, can I get $50,000 for renovations? What renovations cost $50,000? You know, so
I'm just getting some new door handles.
Yeah, I know. I was like, oh my God, such an amateur. Anyway, and then they were like, yeah, cool. Then I went back again. I was like, oh, need another $50,000. And they were like, yeah. And then I must have borrowed $150,000.
Did it freak you out?
Kind of, but not really, because I was like, well, I'm adding value and yeah.
Quite fun to just be able to borrow more and have a little budget for your renovation.
Yeah.
Like obviously you're paying interest on it, but also
you still have to pay it back. Yeah,
quite amazing.
But I think the second time when I asked for $50,000, they were like,
how are you going?
Yeah, like, are you going to just come back and keep asking for money? Like, at what point is this going to stop? And so I had to kind of convince them, I think, the second time around. I was like, no, trust me, this is the final amount. And then I needed more. And I was like, oh, God.
Kidding, and back again. But I think this is a really good example, though, of when we talk about high interest rates mean prices are low for houses because debt is really expensive to borrow.
Yeah.
But when interest rates are low, i.e. in this situation where Vic is wanting to borrow money to be able to add value to her house, it makes total sense to do it because the interest she's going to pay on that
is low. Whereas if that was 7% interest rates,
you would have thought twice about it.
Well, I probably wouldn't be able to afford to do a renovation because I'd be paying so much in interest. But like if you're borrowing more, you then have to pay more as a dollar amount pay back over time. So it's like, yeah, there's like so many, I guess, handbrakes on the economy and productivity and everything when interest rates are so high, which is what they're there to do, right? It's to slow down the economy.
In 2021, so the year after you renovated, is that right?
Yeah. A few years after, yeah.
A few years after you renovated. And this was
COVID.
Was it COVID or pre-COVID? COVID. Okay,
yeah.
Right.
Well, 2020 was the start of COVID.
Right.
Yeah.
And at this point in time, rates were like even lower, right?
Yeah, rates went so down because nobody knew what was happening in the economy or like what was going to happen. People weren't able to work. So yeah, governments all around the world reduced interest rates like super rapidly. So they went down to 2%. And I was like, happy days.
You were like, oh, maybe I'll build a shed.
And I remember having conversations with people at work and they were like, oh, we've locked in, like these rates are so low. Like we've locked in like 5-year fixed mortgage rates. And I was like, you guys, they're going to go lower. Like they've been so, like I'd only known like 3.5 was the highest it'd ever been. And I'd been, ever since I'd owned a house, they've gone down and down and down and down and down. So I was like, that was all I knew. So I was like, well, of course it'll just keep going down and down and down and down. Anyway,
Oh,
jokes
wow.
on me.
It's honestly just so funny how sometimes, when people say, oh, age is wisdom,
Yeah.
I think when it comes to money, investing, interest rates, everything, having a really holistic view of the economy,
Yeah.
age does give you wisdom because, of course,
experience as well,
you didn't
yeah.
know any different. Of course, you were going to think that.
It's totally, and it's like when the stock market just goes up and up and up and up and up, and you forget. It becomes such a distant memory, or maybe you've just joined your investing journey. You've never experienced a correction in the stock market. That
I remember when it first happened, and I was like, panic.
yeah, you're just like, you don't know what it feels like if you've never experienced it. So therefore, it's not in your wheelhouse of thinking. Yeah. So then in 2021, the world was still a bit of a like, what the F is going on? Interest rates were super low, and then we came out of COVID. Remember, and it was like, everything was going like absolutely gangbusters. We had like super low interest rates. The stock market was on a tear.
On a tear.
Like honestly, everything.
Sounds painful.
Everything was just like super exuberant.
Wait, when is this?
This is kind of 2021.
Oh,
So
right.
interest
so
rates
as
were
interest
super
rates were
low.
and everything was going off.
And remember the stock market's forward looking. So that had like roofed it.
Right.
Interest rates were super low. I mean, people had lost their jobs, etc. But like it was
the golden days, wasn't it?
Yeah. I was like, how do you sum it? I mean, golden days for some people probably like, oh my gosh, like how am I going to earn a living? But yes, golden days for investing, essentially. Like the tech companies, the Zooms of the world, the
That's right.
the
Oh my God.
Pelotons.
Yeah.
Everything was just,
Was cost of living at this point a huge topic of conversation? Not yet, right?
No.
Yeah.
All the bottlenecks of like supply chains and logistics hadn't quite got to us yet. So, and then kind of 2023 rolled around and they were like, whoa, okay, we need to kind of slow down this economy. So interest rates went up.
And Vic had not locked in her 2% interest at this
No,
point. We were
no.
floating, right?
Yeah.
So
I've
off
even
we
still got a
went.
friend that I worked with who locked in 2%. And it's still 2%.
They're still at 2%.
I know.
What
I know.
genius.
He was just sitting there, this like young guy, just sitting there, just like laughing at all of us. Like,
How on earth did he manage to do it? I don't understand. Like,
he's
why would
smart.
banks? But why would banks even let them do that if they know they're not going to be that low forever? Wouldn't everyone just lock them in?
well, it's kind of like you could do, usually it's like, okay, let's say interest rates are 2%. 6 monthly might be 2%. Like the longer you go out, the slightly higher it is, but it might have been 2.5. You know what I mean? So you're sitting there when interest rates are 2% and we've been falling and falling and falling. And to be sitting there and able to lock in 2.5, which is slightly higher for 5 years when you're like, well, they've been falling. So what if they fall to 1 and I've locked in 2.5? So it is kind of like you're trying to be like, oh, what's the next 5 years going to look like? And so it's a bit of luck and
God,
experience.
he must have been. Was it a guy?
Yeah.
Absolutely stoked
Yeah.
when all of this started kicking off.
Yeah, and I remember everyone in the office is like, ugh, like dying with like interest rates going so high. Anyway, that's when I left my job.
So basically, interest rates went from 2% to 6%. Vic went from 300K to
Like 70, I think. we went to.
70,
Yeah.
maybe even 60.
Yeah.
And I mean, surely at this point it was sort of panic station. This was the first year you were full-time in the curve. Not great timing.
Well, I think I did. Yeah, no, I think what came first was they left my job and like interest rates were going up, but like they went up and up and kept going up. And I remember being like, oh my dear, like when is this going to stop? Like I can't afford it. And then I went to the bank and I was like, look, this is my situation. I want to go interest only. And they were like, no. I was like, help. Anyway,
Wait, why'd they say no?
well, they were just like,
You're fine at the moment.
yeah, like you can afford it, but it means I can't like have any of the luxuries that I had previously had. So
Is that because they could see what was in your bank account?
Yeah.
Or,
yeah. Anyway, and then I swapped banks and I was like, okay, well, if you're not going to help me out here, I am going to go to another bank and get interest only. But the key thing with interest only though is you're not making your debt smaller. So I'm not getting like ahead, if that makes sense. And that's one thing to remember is that interest only is great, but you are not paying off your debt. So your debt is not getting smaller. So you're just going to keep paying it for longer and longer, if that makes sense. You know, like
it's a short-term solution. It's not long-term.
I'm just kind of going around in circles.
Yeah.
Like I'm not.
Because you're still having to pay interest on the total amount that you owe.
Yeah.
So if you're never paying down that principal, i.e. the total amount of money you owe the bank, then you're paying interest without getting literally anywhere.
Yeah.
The point is the more you pay off your principal, the lower your interest gets because you're paying interest on a total number you owe the bank.
Exactly. Yeah. So it's like having an interest rate and not paying. It's like having a credit card and not paying anything off. You're just paying the 20%
you're on a
interest.
hamster wheel kind of.
You're just on a hamster wheel. You're not paying any of the, 10 grand of debt. It's not getting any smaller, staying the same, and you're just paying the same amount of interest. Whereas if you pay, even $100 off that credit card, you're paying interest on $9,900. Yes, more. Yeah.
Should we take a look at the old Daily Mail article that went out at this point in time? The title being Homeowner Reveals Shares Paying $60,000 a year in Mortgage Repayments After Interest Rate Doubled.
Like, how was that headlines? I feel like that was pretty much a lot of people in the world had seen their interest rate double.
Not many people talked about it publicly.
Or put dollar
Everyone
amounts
was
extra.
suffering in silence. Financial expert Victoria Harris initially paid $27,000. Oh, right, so it's $27,000. The Curve founder said interest increased to 6.5%. New Zealand's economy has entered a recession. And then there's this video that we put up on TikTok that did go quite viral, and it was you talking about your interest rate.
So I was paying $27,000 6 years ago at 3% mortgage rate, and now
What's the
paying
percentage now?
6.5%.
So it's basically double.
It's more than doubled. Yeah, I'm paying about $60,000 a year. So I'm paying now more than double what I was paying.
The New Zealand-based duo received more than 350 comments, with many criticising Ms. Harris. I forgot about that. So many guys jumped on this video and were basically talking to you like mortgage, you didn't know what you were talking about.
Yeah, she can't have had paying that much interest of their mortgages. That I was like, mate, my calculations are right. Also, like, I'm the one paying it. I know what I'm paying. Like,
this is one of the comments. Yeah, that's what can happen with interest rates. They can vary dramatically due to the economy. Why is she surprised?
Because I said
Jonathan.
I'd never been in an environment like this. And that's a valid comment. I should have done my numbers and been like, okay, if interest rates do double, can I still afford this? But that's what the bank's job is, right? They're supposed to factor in these rise in interest rates. We're also in a world that nobody had expected. So credit to me, thank you. Like,
I agree.
One thing I should say is the bank during COVID time, I remember, was super accommodating in terms of like anyone that needs like to pause their repayments or anything like that, definitely get in touch. Like, they don't want to go down the route of like putting you in financial strife or going through a mortgagee sale or anything like that. They want to help you keep your debt because then you pay interest on it. But it's just to remember that like if you did pause repayments, it's not like, cool, there's just 3 months I don't have to pay. That just gets added on to the end of your mortgage. Like your debt's not changing. If you're not paying down your principal, your debt is not going away. One thing you do have to tell the bank is when your salary changes.
Do you?
Mm-hmm.
I didn't realise that. So you have to give them a little FYI.
If anything, like substantial changes. But also I had a massive investment portfolio that they do not care about.
Really?
They don't care about your assets. They don't care if I had 7 other houses.
Why?
Because it's like your serviceability of the mortgage is what's important. Can you pay your interest and your principal each month or each fortnight or whatever it is?
When you say they don't care about your other assets, can you just elaborate on that? Do you mean, for example, if you, in that situation, you'd gone to them and said, hey, look.
Like I was like, look, my salary's gone down, but I've got all these investments, which is super liquid, which I can liquidate in a heartbeat if I ran into financial strife and needed and couldn't pay my mortgage. And they were just like, no.
What do you mean, no?
They were just like, we can't, like that's not income for you. So it's like that is an asset. And to be honest, that asset could go to, could decrease in value very, overnight. But they don't, it's all about your income. And that's why I like pensioners. It's so hard for them to buy property at their age because they're on pensions. They don't have income, or when you're retired and you don't actually have income, really hard to buy assets because you don't have that. So you can't service your mortgage.
But you were able to pause even though you had assets and money. I
removed my principal and I changed banks because the bank I was with was quite inflexible. And I changed banks and was able to go interest only, which was a huge, huge help.
But I'm just trying to understand when you say the assets are kind of unimportant. Do you mean when buying? Do you mean if you have to change what you're paying back? Like I'm just trying to understand what you mean by that.
They're unimportant. Like all they care about is what is your income. Like your asset, like obviously your deposit and what you put down is important, but like they just care about what when it comes to your mortgage and paying your mortgage, like they just care about what your income is coming into your bank account and your outgoings, like, but they just care about what that income
But were
is.
you basically highlighting your assets to say, look, don't panic. I'm not going to have to sell because I have all of this behind me.
And it is liquid stuff that if I get to a point where there's 1 month where I can't pay, I've got this sitting
other
here.
stuff that I can sell.
Yeah.
But was their response to that, we actually don't mind if you have assets that are liquid or you can make liquid very quickly. The only thing we're looking at in this current situation is what
income.
is the money coming in? And you're right, you don't have enough to pay for interest and principal, so we'll pause your principal for now. Was that kind of what happened?
They said we won't allow you to go to principal.
No, sorry, the second
the
bank.
second one. Yeah, they were like, I just went to them and I said, look, this is my situation. This is my income. Can I go interest only? And they were like, yeah. So it was like, it's just like shopping, like it's like, do you want my
business?
Do you want my debt?
Yeah, because you have to think of the debt for them because they're getting interest, right?
Yeah.
And that's exactly what we said before. The bank is making money off helping lend you money and then you pay them interest. So you would be paying the other bank interest, but because they weren't helping you, you can transfer that debt so that it's almost owned by, or the responsibility is now with a new bank, and they're the ones that then get your interest. So it's in their best interest to try and accommodate what you need.
And I think it's also like having a phone with a certain provider, right? If your phone's with Vodafone and they're not giving you a level of service that works for you or aren't being accommodating, you can shop around. You can be like, okay, you know what? I'm going to take my service or my phone or my mortgage somewhere else. I think people forget there is flexibility in that.
And I think don't underestimate what a conversation and asking the right questions can do, because Vic, in that scenario, if you hadn't gone interest only, I imagine you would have had to just completely eat into sell a lot of your investments, right?
Yeah.
Like it would have really hindered your ability to.
Yeah. And I knew I wasn't in like a dire, because like they were like, oh, you want to go down financial hardship route? And I was like, no, like I just want to stop paying principal so that I can still
maintain my position but not be so stretched.
And there was just like this kind of like computer says no, and I was like, oh, okay, I'm just going to go. And I had been there with them for a couple of years. So I was like, you know what? Maybe it is time to just shop around. And so I did.
We were talking before about how time almost breeds wisdom. And if you don't know what interest rates have done over a long period of time, it can be quite hard to make a decision on locking in a fixed rate or a floating rate.
Yeah.
You don't really know what's good, what's scary. Do you think it would be worth just doing like a brief history lesson on where interest rates have been over a period of time to give context for like how much they can go up and down?
It's kind of unlimited, to be honest. Like we could have interest rates of 20%. But gosh, the world would be absolutely flying at that point. Sorry.
God, 20%.
The world would actually be an absolute basket case at that point. We could have interest rates like Japan has had negative interest rates. Like
they're paying people. To take money out.
Yeah.
You're joking. Give me money and I'll also pay you to take it.
Yeah. You borrow $1 million, pay back 900 kind of thing.
What? Why are we not all living there? That's amazing.
It's a bit of a like
counterproductive to the whole
just
economy.
Like, it's kind of like when the system breaks. It's like there's something serious.
It's like deflation.
Yeah. Yes. So, but if we do a bit of a history lesson, over the last 30 years in New Zealand, so mortgage rates were about 11% in 2008.
So that would have been...
Yeah, that was the global financial crisis. This is all floating interest rates because like fixed just changes like depending.
Yeah. But so let's just use your example where you went from 2% to 6%, so it tripled. If it went from 2% to, did you just say
like
20%? 11%. God, that would be like over $100,000 in just interest on what you were
Yeah.
originally paying
And if you
27
think like
for.
that's people's entire incomes, even more, like how can you pay that? And that's when you
Surely
really
everyone has to
start
sell.
yeah. And that's kind of, I guess that's like the second flow-on effect of what happens when there's a recession or a global financial crisis like there was. It was like, yeah, you start having people that are just like, I need to sell my house. And then
So
people
sad.
can't afford because they can't take out mortgages. So then these people that have to sell them for way less. And like this is when the banks get into trouble because they've lent too much money. And it's like,
Oh my
yeah,
God. There's just a downward spiral.
yes. Yeah. And so this is why there's actually been a lot of regulation put into place about these like loan to value ratios. So the banks can't lend.
My dad always talks about the LTV.
Yes. So it's essentially just like it is the amount of equity versus the mortgage. So they cannot lend you more than 80% of the property price. So if you've got $1 million house, 800 grand is the max that banks can lend you. So you have to come up with 200 grand deposit. So in the UK, there's situations where you can put down 0%. So you can go to the bank and get 100% mortgage on your property. So if the house is $1 million, you can get $1 million mortgage.
Is that just different banking systems have just different regulations and
Yeah.
There's no real rhyme or reason. It's just what works for New Zealand, what works for the UK is all very different.
Yes, yeah. And with those, you end up paying you pay a premium interest.
If you're borrowing 100%.
Yeah, yeah. And even in a situation with your LVR, if it's like 90%, so.
And you're only paying 10% of your.
Then you pay slightly, like it's almost like an insurance premium on top of your mortgage rate.
And that's just because they're taking more risk because
So
they're putting in more than you are kind of. They're not.
Yeah.
But sort of.
They've got to be compensated for that extra risk that they're taking essentially. But yeah, a lot of those kind of changes came in after the global financial crisis because like if your interest rate's going from 3% to 11%. Oh,
so stressful for so many people.
Yeah.
If we were to look at other countries, have they all, like in the global financial crisis, was that when everywhere all over the world interest rates were skyrocketing, or is it?
A lot of them, like Australia didn't really like get affected by the global financial crisis really.
I feel like they've done so well through all of these enormous financial hurdles.
Yeah, they have.
Like even now, if you look at the New Zealand economy or even the UK economy, it's struggling a lot. Australia's not.
They're more tied to China and China's growth. Right. So a lot of their money into their economy, their GDP, all of that is tied to exports to China. So big mining country, Australia. So a lot of like iron ore, a lot of like aluminium, steel, like all of that. So when China's booming, it's buying from Australia. Australia's booming.
Okay.
Very simple kind of economics 101. But yes, Australia, the highest theirs got was in 2023. So when mine went up in 2023 in New Zealand, so did Australia's, but it was about pretty something like about 7 to 8% was the highest that they've had. And in the UK, they peaked at about 9% in 1998. So again, not as impacted as the global financial crisis as New Zealand was. But yeah, I guess it just shows like these big swings, right? Over like, and the reason I chose 30 years is like usually you have a 30-year mortgage. That is kind of a standard time frame of a mortgage is about 30 years. And so you need to be
prepared for the ups and the downs.
Yeah. And I think it's just like remembering that, yes, we might be in a low interest rate environment now, or we might be in a high interest rate environment now, whatever it is, it could still get worse. You know what I mean? I think it's just factoring in that, looking at your financial situation and being like, are you prepared that if interest rates went up another 3 or 4%, like could you manage it? Is there a way that, could you cut back on something, or are you living so tightly and your mortgage is so much of your income that would really have an impact on you or your household income or whatever? Like that's because a few percentages here and there shouldn't be a huge impact on your financial position.
Do you almost feel like it would be sensible for people to look at mortgage rates, whatever they're on now, and think that they can go up at least 6% in either way and be prepared for that? Because what I'm seeing here is, 2% to 10%. That's like 8% difference across a 30-year period.
The good thing is it doesn't happen overnight, right? That's when you get like serious shocks in an economy. Like these do steadily go up, but like also steadily like it helps kind of ease the burden, but you're still going from, like 3% to 7% or whatever it is. But it does help you like slowly adjust your outgoings or your spending, or like give you time to talk to your bank, or like all of that. But yeah.
The one thing I am almost thinking is a lot of us probably leverage ourselves as much as possible and really, we said this at the start, stretch ourselves from a deposit point of view, don't have a lot left over. I think the main thing that this is teaching me is if you are buying a property that you are living in, so this is, you're not outsourcing the rent isn't paying for its mortgage, etc., like what I've done with the investment property, but actually you have to be able to sustain your lifestyle as well as pay back your mortgage and the interest.
Yeah.
You don't want to be so close to the line that that if things go up a lot, you're unable to do anything.
Unable to pay for childcare, unable to like
pay for food, pay for electricity, like basic things. I think
that's really important. Like yes, what the banks will lend you is a dollar amount and what they can like risk-wise lend you, but like it's not a target. You don't have to borrow all of that. Like yes, the bank was lending me 900,000. I didn't have to go for all of that. I could have gone for like 700,000 and bought a smaller place somewhere else, like
and been less financially stressed in the time in which the interest rates went up a lot.
Exactly.
What kind of buffers do banks normally actually put in place for these rates moving? Do they factor in that 8% difference?
Yeah. So like whenever you borrow money, you should be factoring higher interest rates, but the bank also does as well. And I remember when I was going to borrow, and I was like, but I can afford this. Like why? I think I did like a back of the envelope calculation. I was like, cool, okay, this is like what I can afford. And anyway, what they lent me wasn't as much as I thought they would lend me. Thank goodness. But yeah, they're doing stress tests because they're putting in kind of an extra 3-ish% on top of in terms of interest rates. So if interest rates are at 4%, they're putting in 7 to make sure that you can still pay it at 7. Do you know what I mean?
I know, but I guess looking at those, like the 30-year time horizon and how much they've gone up by like 8.
Yeah.
So it just feels like I understand 3% is them being super cautious.
Yeah.
But at what point do you need to take your own responsibility around knowing it could go even more than that? Or
I mean, those 30-year timeframes, right? There's been like 2 or 3 situations where we've got in certain regions, only like one situation where you've got that high interest rates. So the risk you would hope is like, okay, if it's going to happen once in 30 years, that it's also like, what is the reason behind that interest rates going up? Like there was like COVID, which is totally out of the blue. How do you navigate that from a personal finance point of view? But yeah, that's the banks. Like that's why the more you can put down in equity, the better, because you've got that buffer, right? In terms of like.
But what do you mean buffer? Like as in you could pause your principal because you paid so much off?
I mean as in if house prices fall because there's whatever else is going on in the economy, like global financial crisis, house prices were falling off a cliff.
And you're paying huge interest. So not only is your asset worth way less, but you're paying so much more on it.
And then if you're like, look, I actually can't afford to pay this anymore, I need to sell it. You're selling it at a lower price. So it's like it's all interrelated. It's not like interest rates go up or down dramatic amounts in isolation. Like there's so much else going on in the economy. But yes, the banks do put in a buffer because they're the ones taking the risk at the end of the day on you in terms of hoping that you'll be able to pay them back over time. So yeah, if you're sitting there going, but hang on, I can afford interest rates right now with my income, like doesn't really matter. They're factoring in that kind of 2.5-3% extra in terms of the buffer.
So do you think then the general rule of thumb here is a bank is not going to lend to you if you're not able to keep up with interest rates either being less or far more expensive?
Yeah.
You don't need to on top of that factor even more for like double worst case scenario.
Yeah.
You just need to be really aware that you don't want to be so close to the line in terms of how much you're borrowing so that you're so stressed if the worst does happen. It's just understanding the risks.
Because like in my situation, right, interest rates went up and the bank was like, well, you can still afford it. But I would have had to seriously change my lifestyle. So it's like if I had factored in Like, do you know what I mean? Like, they don't care about you having to change your lifestyle.
Right.
So if you're like, well, no, I actually need to pay for these essential things, or I don't want to significantly change my lifestyle, then you need to factor in or borrow less or factor in a higher percentage buffer and all of that. So does that make sense?
I guess the lifestyle thing's really interesting because if you're a single person without a family, it's one thing.
Yeah.
If you have kids and you have other
dependents
stuff to pay for, what a bank or someone else may assume is essential versus not essential is,
yeah.
do you know what I mean? Like I guess you have more
you have more control
when it's just you.
But I think it's also with like banks, they are incredibly helpful, and I think I just want to reiterate, like, the worst thing you can do if you do start feeling overwhelmed with your mortgage is to like bury your head in the sand and not talk to them, like, and just avoid paying month on month on month. Like that is worst case. Like front foot it. Be like,
just like you did. You massively front footed it.
Just front foot it and be like, look, this is my change my situation. Don't ignore it. It's like with any debt. Like call the credit card company, call the mortgage. Like just don't. The worst thing you do when you're feeling overwhelmed is avoid. Like you just need to front foot it. And I think you'll be quite surprised at how helpful or the options that the banks have that you probably never even thought of. Like interest only, like deferring your payment a couple months, giving you a bit of like breathing space. Like all of these things they introduced during COVID was super helpful. People that have lost their jobs and people that, you know, are trying to navigate this new world. So, yeah, I think that's just something is like, don't bury your head in the sand. Also talk to friends and family. You know, they might be like, look, we're happy to help you out for a couple of months or something. They might be like, you know what, we'll look after your kids, you know, to pay for childcare. I don't know. I'm like, I won't keep coming back to childcare, but like,
well, I think it's just infinitely more stressful to not be able to pay if you're not the only one you're worried about. Like a house is where if your house is where your family lives and it's your kids' home and it's their sense of stability, the idea of having to sell or move or whatever would be super overwhelming.
And banks are humans. Like they are big institutions, but they're also humans in there. And like the last thing they want to do is for you to force sell your house in a mortgagee sale. You're not going to pick up the phone and be like, hey, look, I'm in a bit of financial hardship or like I need some help. They're not going to be like, oh, your house is up for sale. You know, like they're not that ridiculous. Like
and I think that's probably
for them is their last resort. So yeah.
No, I think that's really good advice. Okay, I think we should chat about actual tangible steps that people can do, think about, consider if at any point in their life or at any point in their home ownership journey, they need to seriously reconsider what they can afford or how they approach repaying their mortgage. What are some of the top steps that we need to think about, be aware of? And you might not be in the situation right now, but it's really, really good to know this if and when you ever are.
Because economies change, right? Interest rates change, your financial situation change, your job might change. Yeah, and this is from BNZ, Martin King, which is their general manager of customer assist. From his perspective, like a mortgagee sale, they are so rare and they are genuinely the last resort. So there's so many options that banks go through before they get to that point. So I think, and I felt like this, like there's this fear that if you let the bank know and you're a bit vulnerable with them, that they're going to come down hard or that they're going to like
be putting a for sign sale outside your house before you've had a chance to think about it.
You're going to lose your house and you're going to like, it's like, no. Like, that's such unique cases, and that is,
it's worst case scenario for them as well as for the person who owns the house, and they try and will try and collaborate with you in any way they can to make sure that doesn't happen. Yeah,
they work really closely with you to find a solution. But some of the tips are like, firstly, like just take a breather. I think is really important. Like we're talking about being overwhelmed here, and I think being overwhelmed, you know, your mortgage is probably one part of your financial situation that's feeling overwhelming. Probably the biggest part, but it could be that like, you know, there's so much other debt, there's so much, expenses or, you know, something's gone wrong. Just take a breath, sit down, get all your numbers in front of you. And I mean, we talk about that all the time when we talk about, you know, budgeting, getting out of debt. It's like just lay it all out in front of you to get like a clear picture, first of all. And then, you know, write down like what are your current repayments? When does your rate expire? Because we could be in a situation where you could be a couple of $100 more, you know, better off in a few months, and that might just need to be tied over for a few months or something like that. You know, write down when your fixed rate expires, what's your new rate, and then kind of what the repayments look like. And again, if that changes, if the interest rates go up and you need to pay more, then at least you just have the full picture, right? So
I think as soon as you have numbers, facts, everything in front of you really clearly defined, and you instantly feel more in control. You know, it's just like if you redo your financial budget for yourself, or in any situation, say you need to pay someone back, or if you know what needs to be done, it's like, imagine a bubble of anxiety is burst as soon as you've done the work to understand it more.
Yeah.
Yes, it's still overwhelming sometimes, and yes, you still have things that you have to like seriously action, but I do think a huge amount of mortgage overwhelm is people feeling out of control because they haven't stopped to put themselves back in the driver's seat and figure out what they need to do.
It's also removes a bit of the emotion, right? You kind of look at it a bit more pragmatically. You're like, okay, cool. This is what I've got coming in. This is what I've got going out. This is what it's going to jump to or whatever. This is what I need. You know, it's just a bit more of a objective view rather than like an emotional view. The second thing, we kind of touched on this, but talk to your bank early. Like, they genuinely want to help you out. And yes, there may have been people that have had bad experiences with banks, but 99% of the time, like they want to help you get out of the mess. They don't want to make your life harder.
Also, when you go in a total crisis in the 11th hour, you're not really giving them the chance to help you find a new way forward. So I think what your example, Vic, where you immediately saw, okay, I'm going to have to change my lifestyle.
Yeah.
Or I could do this. And if your decision is, I don't want to have to change my lifestyle, or whatever your personal situation is, front foot that as soon as you know, rather than waiting to be desperate.
Yeah.
And then I think also you just get so much more emotional.
Yeah. And I think it's also, there's options that I didn't even know existed, right? Like, there's things you might be like, oh, well, you know, the only option is interest only. It's like, no. There's so many other things. You can extend the term of your mortgage, so all your repayments come down. You can get temporary relief where you don't pay for a few months. Like, there's so many different ways to cut it that could be helpful to your situation, depending on what your situation is. But I think the overarching thing is that just like early conversations give you way more flexibility, because if you haven't paid your mortgage for a few months and you've just ignored the bank's calls and all of that, they're going to be in a bit more of a pissed off situation as well. Do you know what I mean? Whereas if you're like, look, I can see my income is about to fall, I'm about to lose my job, or, you know, and my repayments are going up, what's the best way to navigate this? You can figure out a solution together. Number 3 is check whether you can save money elsewhere. So this is kind of coming back to your lifestyle changes, right? Like, you know, is there things in your non-essentials that you can cut back on? Like, subscriptions. Can you talk to your electricity provider? Can you, you know, try and get a better deal there? Is there a better insurance plan? Like, all of those things can really help, even though it might be only like 30, 40, 50 $50, £50, like whatever it is. It can also, you know, can just alleviate a bit of financial stress.
I think it's almost this one is like go back to the drawing board.
Yeah.
So once you know everything once you understand the mortgage position and where you are, it's then taking a second look at your numbers everywhere else.
Yeah.
And feeling confident in knowing where you could either pull money from or readjust or rework things, or as Vic said, actually save money to free up more to be able to put towards the mortgage repayments that you're now either behind on or stressed about.
Yeah. Number 4, don't suffer in silence. And I think this is a big one. Yes, we said talk to your bank, but like talk to family and friends. I reckon there'd be so many people within your circle of friends, your community, that have been in a similar situation that could have quite unique and creative ways of helping you out, or something they did that you might be able to implement. Just don't suffer in silence. I think that's a big, for any kind of debt. It's like, I don't know, they might also be suffering and you can suffer together. You know, like it's just like, yeah, I think it's just, you don't know how many people that have probably gone through a very similar thing.
I mean, that's probably why this went off on Daily Mail, because you weren't, I mean, how many people were suffering with those increased mortgage rates?
Yeah.
And it's so many, most people all over, not just in New Zealand and Australia, but everywhere.
Yeah.
So talking about it publicly makes other people feel validated that they're also, what they're experiencing is also stressful.
Yeah. And lastly, I think is talk to a broker or an advisor. Like, I think mortgage brokers are totally underrated. Like, they are there to go and shop around and find new rates for you. Like, when I was talking to my bank and they were being inflexible, I did it myself and went to talk to another bank, but I could have got on the phone to a broker and been like, look, I want to go interest only, and this is my current situation. Like, can you go and find me a bank that can do better than this rate that I'm currently at? Like, that is their job, and you don't have to pay them. They get paid by the banks. Like, they're out there to find you the best deal. Whether you're getting a mortgage for the first time or whether you're feeling a bit overwhelmed and wanting a change, wanting to like refinance and find a new deal.
The more people you talk to, the better.
Yeah. And
obviously start with your bank first, but if you can't get what you need, then there's other people you can talk to as well.
Yeah.
Amazing. I mean, I really, really hope that nobody ends up in a situation where they're so unbelievably overwhelmed and there's nothing that they can do about it. But hopefully having this conversation and understanding, we've all been there because I haven't yet, touched wood. This is the cycle of economics. This is what happens in the world. There's so many things that are in place to make sure that you don't end up in a pickle. But you actually, the more that you know your numbers and the more that you're aware of what's going on, the more that you can avoid worst case scenario happening.
And I think it's a good point, Soph, is like, it is a cycle, right? It is a cycle. Like, we have had interest rates go from 2%, super low, up to about 6 or 7, and now they're back down to like 3, 4. They're back down to 4. Like, things move in cycles, and I knew this was not going to be a
like
forever
forever
situation. I just needed to like knuckle down, get through it, and yes, every time interest rates didn't go down, I had a little, but they do eventually. And I think
if you'd had to adjust your lifestyle or whatever, there were other levers that you could have pulled if it continued in that way.
Definitely. But I think it's just worth knowing, like, they never last forever, even when they're low as well, which is also something to remember. But
what do we do when they're at 2%? We lock it in. Okay. Hey, we are going to be back next month with more property content. Again, if you're listening to this and you have questions, thoughts, ideas, anything that you want us to explore in the property space, please let us know. We want to make sure that this podcast is as helpful to you as possible. And thank you so much to BNZ for empowering this podcast. Did you love this episode?
Yes.
Have you got property front and center in your mind? Sounds like you're a 5-year-old.
I know.
Now could be the time to take the first step towards what it is that you're wanting to buy. Whether that's your first home, whether that's a new flat, whether it's, I don't know, buying another investment property.
And thankfully, BNZ has the expertise and tools to help you get started, and their home loan partners are ready whenever you are.
You can book an appointment, you can ask millions of questions. Trust me, that is totally fine. And you can start turning the property dream that you have into a plan and hopefully soon into a reality. I know from experience that this can feel quite overwhelming, but when you're working with experts who can actually help you get there, it's such a burden off your shoulders to know that you've got the advice and the tools that you need to actually make it happen.
We know how hard it can feel and like overwhelming and just, so like a fish out of water when it comes to buying property. So we're so thankful to BNZ to be helping us create and empower this podcast so that people can learn, and we just want you all to succeed. We want you all to succeed. We're all in your corner, and this is going to be such a game-changing property podcast series.
Yes, and for anyone that is going through the process of either buying a house or a flat or whatever it is that you're trying to do, please let us know, because we would love to be cheering you on from the sidelines. But thank you so much again to BNZ for empowering this podcast. Okay, quickly, The Curve was created to empower and educate you about investing, but we are not financial advisors.
Our platform exists for educational purposes only, and it doesn't provide personalized investing advice for your individual needs and should not be relied upon to make an investment or financial decision.
And always remember to do your own research before making any investment or financial decision.
We're here for any knowledge and support you need, but the final call is always yours.
And thanks for being here.
You got this.
Yeah, we know you got this.